For anyone that has a brokerage account, which is an investment account that's not tax sheltered, it's not like a 401k or something like that. It's just a standard investment account. If you have one of those accounts, you have to accept that there's going to be some tax implications for having that account. And in particular, when we're talking about stocks, your brokerage account that you have set up through some vendor, we talked about Fidelity and Vanguard and Schwab in the last video. Regardless of what vendor you're using, there's going to be two potential taxable events. So a taxable event is some sort of trigger that could cause a required tax payment. But not all taxable events lead to taxes, as we will see. So just as an example, somebody with no income, if they earn $100, that's a taxable event, but it won't actually be taxed because they're below what we will learn is the standard deduction. So a taxable event is something that could trigger taxes, but it isn't guaranteed to do so. When it comes to stock ownership in a brokerage account, there are two scenarios where you can trigger a taxable event. One of those would be from the sale of stock. Whether it's a profit or a loss, it could trigger what we would call a taxable event. It's something that could impact your tax bill. And there's specific rules on how long you will have held that stock for how it becomes treated from a tax standpoint. Okay? So when you sell stocks at a profit or even at a loss, it has implications on your taxes. And then the other event would be dividends. So when you get those dividend payouts, those are also taxable events. If this happens in a tax shelter like a 401k, there's no taxes to worry about. The only time you have to worry about taxes in the 401k and accounts similar to that is when you're withdrawing from those accounts. In this case, though, there's taxable events even if you're doing nothing. You know, a dividend is something that will get paid out to you when you're not actually actively making any changes to your account. This just is something that naturally is paid out, and it will trigger potential taxes. So to understand how these are going to be taxed, we need to learn about a new concept, capital gains taxes. So we've talked about income taxes, Social Security taxes, Medicare taxes. The next very common version of taxes that you're going to pay at some time in your life is capital gains taxes. So let me give you a scenario here, and I'm not even really telling you for now what causes capital gains taxes to occur. You need to see the math first, and then we'll see scenarios where you will actually have to pay taxes and what those circumstances would be. So let's say you have income of $30,000 and you have capital gains of $10,000, and I'm going to share the capital gains tax bracket there in front of me now. In this scenario, you have to consider both your income and your capital gains in unison, and this is how it always needs to be done. In other words, if you only know what somebody's capital gains are and you don't know anything else about that person, we cannot decipher what will happen from the taxes on those capital gains. So here is what you need to do, okay? And I'm going to kind of try to make this visual for you. The income will be taxed just as it always has been. That $0 to $30,000 is going to be taxed first. That'll be the first thing that we need to consider. And then the capital gains on top of that, even though it's only $10,000, it's like we need to stack it on top of the income. And so this is just a tricky thing, and in the book I tried to explain it the best I can, but it's really something you have to just understand. It's pretty hard to explain in words or to show on a graph. I'm doing my best here. When you consider your capital gains, you shouldn't look at this and say, well, they just have $10,000 in capital gains, and looking at the bracket, they're in the 0% bracket. To figure out where they are in the brackets, you first have to assess their income. So this person's capital gains would be assessed as being between $30,000 and $40,000 on that table, which does actually, in this case, put them in the 0% bracket. So they would have a taxable event because of the capital gains, but in this specific scenario, it wouldn't lead to any actual taxes paid for capital gains. So they would pay the income taxes that they would always pay on $30,000, and there would be no taxes due on these capital gains. Now, alternatively, if somebody had, let's say, $70,000 in income, this is a completely different scenario. Again, the mistake that a lot of my students make the first time they see this is they see the $10,000 in capital gains and say, well, they don't have, they don't have the $47,000 required to start paying capital gains taxes. That's not how this works. You have to first assess the income, which they have $70,000 of, and then recognize that where we should consider their capital gains is between $70,000 and $80,000. So the income all gets taxed. That's done. But after that, where we start for their capital gains is at $70,000. So when we're looking at the brackets, we say, look, they have $70,000 in income. That's where we're going to start on the capital gains bracket. So we go from $70,000 to $80,000. $70,000 to $80,000 in capital gains, that gap between those two, that $10,000 all falls at the 15% rate. Okay? So figure out their income and then assess the capital gains on top of that income. All right? So their capital gains tax would be $10,000 times 15%, or $1,500. That would be their capital gains tax bill. If their income was a lot higher, let's say their income was $1 million, then with $1 million in income and $10,000 in capital gains, that would put them in that next bracket, in the 20% capital gains tax bracket. Okay? And sometimes this can get really messy. So as a final scenario here, let's say somebody had $40,000 in income. $40,000 in income, $10,000 in capital gains, and this is where it kind of is really a mess. Their capital gains then would span from $40,000 to $50,000. Again, it's still $10,000 in capital gains, but the way we assess it is different depending on your income. So what would happen is with this $10,000 in capital gains, a portion of it would fall into the 0% bracket, and a portion of it would fall into the 15% bracket. Namely, the first $47,025, or rather the first $7,025, I should say. The first $7,025 in capital gains would fall into the 0% bracket because their combined income and capital gain up to that point would trigger no capital gains taxes. But the additional amount, that spills them over into the next bracket. So the next chunk of capital gains here, the $2,975, that would get assessed at the capital gains tax bracket of 15%. It's kind of a mess, but it's the type of thing that once you practice it several times and have a chance to have your homework graded, your quizzes graded, it does tend to get easier. So now let's think about how taxes are applied specifically to stocks. And by the way, the table I showed you up there was for somebody who is single. There's the same circumstances with income as there is for capital gains. There's different brackets if you know you're married, filing jointly, or head of household, or whatever. I'm not going to include those in the video, but they are in the book, freefinancebook.com. Check it out, chapter 10. There's a lot of information there about taxes on investments. So let's again get back to the two things that can trigger a taxable event. One of those would be the sale of stock, and oftentimes we think about it in terms of profit, but it doesn't have to be profit. You can actually write off your losses too, which I do mention in the book, but it's kind of a more advanced thing that I'm not going to spend any time on this video for. But if you have stock profit, the way that's taxed is dependent on how long you've held that stock, okay? Basically, the federal government likes to reward long-term investors by allowing them to pay lower taxes than short-term investors, which is yet another reason why it's a good idea to have very simple investing strategies like investing with index funds. If you're trying to pick individual stocks and you're buying and selling, buying and selling, buying and selling, you're going to trigger a lot of taxable events at high tax rates. But if you're a long-term investor who's doing very few transactions, you're more likely to be treated more favorably from a tax standpoint. So the rule on profit from stock is if you held the stock, you've held the stock more than 1 year, then any profits you generate are taxed as capital gains. And that's preferable because, as you can see there, the capital gains tax brackets aren't too bad. Alternatively, if you've held it less than that, your tax is income. And this definitely makes things more complicated because now you can see a very confusing part of this is your capital gains taxes are based on your income, right? We just learned that in the last little example. Your capital gains taxes are based on your income. But both your income and your capital gains are a result of your investing outcomes. So sometimes it can be kind of hard to project what's going on with your income. You know, you can't just be like, oh, well, I make $60,000 at my job, so therefore I know what capital gains tax bracket I'm in. No, your income is also influenced by your investment earnings. So maybe you make, $40,000 from your job, and you have $5,000 in capital gains. So this is income from your job. You might look at this scenario and say, okay, well, $40,000 in income, $5,000 in capital gains. That puts me in having no capital gains tax bracket. But if you also have an additional $10,000 in investment income, right? That would be perhaps from stock that you've held for less than 1 year. That investment income now means that you've really got $50,000 in actual income, and now your capital gains would be placed on top of that. I'm simplifying again, though, because we're not talking about deductions or anything like that. That will happen later on in this class, but you can see all the information that goes into something like taxes, and this can be what makes things very complicated. So that's the rule with the profit on stocks. For dividends, unfortunately, there is a different rule, but fortunately, it is less punitive. It is easier to fall into that capital gains tax bracket, which is what we would prefer. If you've held your stock for more than 60 days is the cutoff. So 1 year is one of the cutoffs. 60 days is the other. You're just going to have to memorize that. Then your tax is capital gains. If 60 days or less, then your tax is income. And so this is helpful to understand just from a tax planning standpoint to be able to solve for our taxes, but also informative when you're thinking about your strategy. You know, if you've held a stock for 360 days and it's got a big profit attached to it and you want to sell it, well, just wait, 6 days before you make that transaction because that will save you some money on taxes. So this is what it looks like for stocks, and I'll try to just give you, a basic example of what this might look like. And chances are you're going to have a lot of taxes to worry about as you get a little bit older. We'd like to have as much as we can invested in tax shelters like 401ks, but the problem with things like a 401k is that money is a lot less accessible than it is in a brokerage account. So most people are going to have a lot of money in a brokerage account, and that means there's a lot of potential taxes happening there, and you got to be prepared to pay them. So let me just give you an example here. Let's say that you make $61,000 from your job, so that's like your standard salary that you've earned. You've also got a dividend from stock that you've held for 10 years, so it's a very long-term stock that you've held, and let's say the dividend on that is $6,000, which would be a lot of dividends, right? Usually dividends are relatively small because companies don't pay out dividends like they did in the past. Pretty small dividend payouts every year. If you have $100,000 in a brokerage account, you might expect to have just a couple $1,000s in dividend payments during the year. But nevertheless, just assume in this case, this person has $6,000 in dividends, and then they also have some stock profit. Let's say that they held some stock for 9 months. So that's how long they held the stock from purchase to sale. When they bought it, they paid $8,000. And when they sell it for $12,000. So you can see this is just like a good example, like I might consider using for a quiz or an exam. But in reality, most people's financial situation is a lot more complicated than this. You don't just have a couple of transactions. You probably have very many. But nonetheless, we can solve for this. We need to make sure we categorize everything correctly. The money that they make from their job, that's income. The dividends from stocks that they've held for 10 years, that's capital gains. And then here we've got income. Now, the mistake that some people will make is they'll say, well, we've got $12,000 in income. That is not the case. The income is the profits. Make sure you understand that. The income is the profit. So we've got $4,000 in income. And so we would want to add these things up, okay? In total, $65,000 in income, and we would run that through the income tax brackets just like we normally would. We'll learn up into chapter 22 about all the deductions and everything else to be concerned with, but for now, we just run that through the brackets. So that goes through the income brackets just like normal. And then we'd also have $6,000 in capital gains. That would be taxed at a 15% rate. And so you would have $900 in capital gains taxes due. And this is all going to have to be handled by you, or at least you in congruence with an accountant or somebody, because your employer is not going to do this for you. Your employer will at least give you some help when it comes to paying your taxes, right? We learned back in chapter 3 that as you earn income, your employer withholds some of that income, and then when you go to file, you figure out if you owe more or if you're going to get a return. But that is not the case when it comes to investment earnings. Nobody's taking any of your income. Nobody's withholding it. This is going to have to be all you that has to handle it, okay? So in this case, this person's going to have a decent amount of taxes due when they file, okay? All of this takes place when you file. Make sure you make note of that if you're taking notes right now. So your income, your regular salary from your job, that money is being withheld. Taxes are being withheld through time. But your investments, all of the taxes due on your investments, you'll have to pay when you go to file your taxes early in the next year. So this can sometimes be a really big problem for somebody. You know, they've had a big investing year and they find themselves with $10,000 in total taxes due, both from income earned on short-term profits, also income earned from dividends or capital gains earned from dividends. All of that is going to be due. So they go to file in April of the following year and find that they have $10,000 due in taxes and they weren't prepared for that. That can be a big problem. That can be a major stressor, right? So it's not just about understanding how the system works. It's also recognizing that you're going to have to pay all of these taxes at once when you file your taxes. So that's what it looks like for stocks. In the book, I do talk about bonds a little bit too. I'm just going to make a quick note of those right now, but I'm not going to go into great detail. The thing about bonds is they are a little bit more complicated simply because there's some interesting rules related to bonds. For example, if you invest in city bonds or state bonds, county bonds, what we call lumped together municipal bonds, if you invest in municipal bonds, there's actually no federal income tax bill on those. So they are totally tax-free. Now, who does that appeal to? People with very high income levels who have very high tax burdens. For people who have low to middle incomes, this is not such an important thing, and it's probably not going to be relevant for you for perhaps ever or for a very long time. Otherwise, what you really need to know about bonds is they are less tax efficient than stocks. So if you're going to hold some bonds, you want to put these bonds into a tax shelter like a 401k or an IRA. And once it's in that tax shelter, there's no taxes to worry about until you sell it. So I could teach you the rules related to the taxes on bonds in a brokerage account, but I think the vast majority of people watching this video aren't going to need any bonds in their brokerage account, or at least very little. So I think you can basically ignore the tax implications of bond investing. I just don't think you're going to need it. Okay? And so just to summarize what we've learned here today, when it comes to investing with stocks, remember that there's a rule, a 1-year rule, and that comes with the sale of stock. Remember that you're using the profit or loss generated from those stocks. So let's say that one stock you sell at a profit for $5,000, and then another share or another 100 shares of stock you sell for a $2,000 loss. Those do negate each other, and so that would be $3,000 in taxable profits there that we need to worry about. So the rule is 1 year from a timing perspective. If you've sold stock that you've held for at least 1 year, or more than 1 year, I should say, it's taxed as capital gains. If you've held that stock for 1 year or less, it's taxed as income. And then the rule for dividends is 60 days. If you've held it for more than 60 days, when you've earned that dividend is going to be taxed as capital gains. If you've held that stock for 60 days or less, it's going to be taxed as income. And I think these are rules you'll probably naturally memorize as you go through some of the practice problems in the book, which, by the way, you definitely should do. This is a chapter where you really want to practice. So freefinancebook.com, check out chapter 10, work through some of the practice problems at the bottom of the page. You're going to see questions, and then you'll see those questions listed again with the answers provided. See if you can match my answers.